Welcome to this edition of IBFD's Tax Takes News and Views, bringing you the week's tax news in a nutshell. I'm Stuart Gibson, IBFD's Chief Editor, Global News in Washington, D.C. For those of you who were looking forward to this week's Beyond the News interview with Barry Larkin, IBFD Special Counsel in Amsterdam, I hate to disappoint you, but we've decided to give our viewers a tax break this week. Don't despair. We expect to return with more insightful interviews in the coming weeks. On today's show, Saudi Arabia announces pay-to-play for contractors. Countries continue to scramble for revenue in the age of COVID. And don't look now, but while the U.S. has opposed the French DST, Maryland has imposed its own tax on digital advertising. These and more on IBFD's Tax Takes. First, we turn to the top news of the past week, as reported in IBFD's Tax News Service. The election of Joe Biden and his appointment of a savvy team of international tax experts has raised hopes that the OECD will be able to convince governments to reach consensus on addressing the tax challenges arising from digitalization of the economy. This would, the thinking goes, lead countries to drop or abandon plans to adopt so-called unilateral measures to impose taxes on digital commerce. In an ironic twist, however, one U.S. state has adopted a unilateral measure of its own. Last week, the Maryland General Assembly voted to override its governor's veto of a bill that would impose the nation's first tax on digital advertising revenue. The tax, which is retroactive to the first of the year, applies to advertising services with a digital interface, including banner advertising and search engine advertising. And, just as the French DST targets large companies, those with annual turnover exceeding 750 million euros, the Maryland tax also applies to large companies, but with a lower threshold of $100 million per year of global advertising turnover. Maryland's rates range from 2.5% on the low end to a whopping 10% on businesses that gross more than $15 billion worldwide. Opponents have already mounted a court challenge, arguing that the new tax violates the U.S. Constitution as well as various state and federal laws. But they should not get too cocky, as other states are already lining up to pass their own DSTs, emboldened by Maryland, as well as their need to replenish state tax coffers depleted by the pandemic and the resulting recession. Apparently, Poland and Maryland are singing from the same song sheet, as Poland may soon impose its own tax on advertisements, specifically designed to raise money to address the fallout from the pandemic. Poland proposes to tax digital advertising just like Maryland, but unlike Maryland, Poland also plans to tax traditional advertising. After the initial draft legislation met with fierce resistance from stakeholders, the government announced plans to draft a revised bill. In any event, President Duda appears determined to press ahead with some form of tax on advertising revenue. Finally, on this front, not to be outdone, Thailand will impose a 7% VAT on digital services sold or delivered in that country starting on September 1st. The former U.S. president was fond of basing his policies on the phrase America First. Well, it appears that door swings both ways. The Kingdom of Saudi Arabia has announced that it will no longer enter into contracts with any business that does not have a regional office in the kingdom. Fortunately, businesses affected by this new policy will have until January 1st, 2024 to build a regional office in Saudi Arabia, fulfilling the kingdom's goal of creating the jobs necessary to build those offices. As we continue to report, countries around the world are finding creative ways to raise revenue. The tiny Caribbean nation of Antigua and Barbuda was still recovering from devastating back-to-back hurricanes in 2017, when the COVID pandemic brought its economic lifeblood, tourism, to a grinding halt. Now that nation will raise desperately needed funds through a number of new measures. These include gradually reducing waivers and exemptions on import duties, implementing a tourist levy on all accommodations, including Airbnb rentals, extending existing sales taxes to online purchases, and beefing up property tax compliance. Germany is targeting an old source of revenue, tax havens. The German Finance Ministry has published draft legislation that takes aim at tax havens through a comprehensive system of targeted measures, including preventing individuals and businesses from maintaining business relationships with blacklisted jurisdictions, and denying deductions for business expenses or treaty relief from withholding taxes for transactions with entities in those countries. And now moving on to other news. It has become increasingly evident in the past few months that there is a COVID exception to the general EU prohibition on providing illegal state aid. The latest evidence comes from a decision of the General Court, which ruled against a complaint from Ryanair. The budget carrier complained that France granted illegal subsidies to rival carriers SAS and Air France-KLM when it deferred the payment of aviation and other taxes on French-based airlines, all to help them deal with the pandemic. The General Court disagreed, concluding that France acted within its authority under the Treaty on the Functioning of the European Union. Ryanair can still appeal. U.S. taxpayers who fail to report their foreign financial accounts can face fines totaling millions of dollars, but the U.S. government reserves its most severe penalty, criminal prosecution, for the most hardcore offenders. Last week, the U.S. charged a naturalized U.S. citizen originally from Chile with failing to report her Swiss bank accounts, attempting to evade income taxes, and immigration fraud. If convicted, she could go to prison and, perhaps more important, lose her naturalization status. And finally, Bahrain has just proved the truth of the old expression, it's never too late to do the right thing. Last month, the Attorney General announced the establishment of a tax crimes unit to investigate tax evasion, specifically targeting VAT fraud. Nowhere to run, nowhere to hide, not in Bahrain. Don't forget to join us next week when we will again have our Beyond the News interview. That wraps up this week's edition of Tax Takes News and Views, the week's tax news in a nutshell. From Barry Larking and myself, thank you for watching. Here's hoping your week is not too taxing.